A 67-year-old retired postal worker in Columbus, Ohio, sat at his kitchen table in February 2024 and opened a letter from the IRS. He had done everything right, saved for 38 years, never missed a 401k contribution, claimed Social Security at 66, exactly when his financial planner told him to. The letter said he owed $11,340 in additional federal income tax for the year. Not because he cheated, not because he made a mistake on his forms, but because the IRS had a rule he had never heard of, a rule that turned his Social Security benefit into a taxable event, triggered by money sitting in accounts he had not even touched yet. He called the IRS. They confirmed the amount. He paid it. His neighbor, a 68-year-old retired nurse from the same street in Columbus, had the same income, same Social Security benefit, same general savings. She paid $847 in federal income tax that year. Same city, same benefit. A difference of $10,493. Nobody sat them down and showed them these numbers. There was no letter in the mail before they claimed. There was no warning on the Social Security Administration website. And today, I'm going to show you exactly what created that gap, and the 3 accounts you may need to empty, restructure, or reposition before you file your first Social Security claim. My name is Jonathan Mercer. Every week on Tax-Free Retirement, I break down the tax rules, the hidden traps, and the strategies that protect retirees from the things nobody else is explaining. Before I go further, I want to be honest with you about something. This is not legal advice. I am not your CPA, and I will be the first to admit that some of what I am about to explain has nuance. Your specific numbers, your state of residence, your filing status, all of it changes the math. But here is what I can tell you with complete confidence. The IRS rule I am about to describe is real. It is written into the Internal Revenue Code under IRS Publication 915. It has been there since 1983, and the majority of people walking into retirement have never read a single sentence of it. That is not your fault. The system was never designed to explain itself to you. Let's get into it. I'm going to walk you through 3 specific account types, and I need you to stay through account number 2, because that one is the account most financial advisors forget to mention. And when they forget it, it costs their clients an average of $4,200 per year, every single year. But first, you need to understand exactly how the 85% rule works, because most people have heard the number and think they understand it. They do not. Here is what most people believe. They hear 85% of Social Security can be taxed, and they think, the government takes 85% of my check. Here is what is actually happening, and this distinction will change how you plan for the rest of your life. The IRS does not tax 85% of your benefit. They include up to 85% of your benefit in your taxable income. Then your regular tax rate applies to that included amount. The trigger is something called combined income. The IRS calculates this as your adjusted gross income, plus any tax-exempt interest, plus 1/2 of your Social Security benefit. If that combined number goes above $34,000 for a single filer, or $44,000 for a couple filing jointly, up to 85% of your Social Security benefit gets added to your taxable income. Now here's the part nobody talks about. Those thresholds, $34,000 and $44,000, have not been adjusted for inflation since 1993. In 1993, those numbers caught only higher income retirees. Today, with average Social Security benefits, a modest pension, and any retirement account withdrawal, tens of millions of ordinary retirees are crossing those thresholds without realizing it. According to the Social Security Administration, 56% of all Social Security recipients now pay federal income tax on their benefits. 56%. This is not a tax on the wealthy. This is a tax on people who saved responsibly and are now being punished by a threshold that has not moved in 32 years. Let me put real numbers on what this means. The estimated average Social Security retirement benefit in January 2026 is $2,071 per month. That is $24,852 per year. If 85% of that becomes taxable income, that is about $21,124 added to your taxable income every year before a single dollar of your retirement savings is counted. At a 22% federal tax rate, that could mean about $4,647 per year in federal tax tied to your Social Security benefit alone. That is about $387 per month. On money you already paid into the system for 40 years. Money the government told you was your retirement security. Money you earned. $4,647 per year. Over 20 years of retirement. That is $92,940. That is a grandchild's college education. That is a second car. That is years of groceries. That is gone. Now, here is where it gets uncomfortable. Most retirees cannot avoid having Social Security income, but what they can control is what else is sitting in their combined income calculation. And that is where the three accounts come in. Account number 3 is the one most people already know about, but the way they handle it is still wrong. Account number 2 is the one that surprises people the most. And account number 1, the one we will get to last, is the income source that, if you do not address it before you claim, can make the planning window much narrower for the rest of retirement. Let us start with account number 3. Every dollar you pull from a traditional 401k or traditional IRA counts as ordinary income. It lands directly in your adjusted gross income, and that AGI feeds directly into the combined income formula that triggers Social Security taxation. Here is the cruel irony nobody talks about. You were told your entire working life to put money into these accounts because contributions were tax deferred. You followed the rules. You did exactly what you were supposed to do. Now, in retirement, every withdrawal from those accounts pushes you closer to, or further past, the threshold that makes 85% of your Social Security taxable. The system rewarded you for saving, and now it is taxing you for having saved. A 66-year-old retired teacher in Phoenix had $480,000 in a traditional IRA. She planned to withdraw $24,000 per year to supplement her Social Security of $22,800 per year. Her combined income, half of $22,800, which is $11,400, plus her $24,000 IRA withdrawal, plus $2,200 in interest income from a savings account. Total combined income, $37,600, above the $34,000 single filer threshold. 85% of her Social Security, $19,380, added to her taxable income. Federal tax bill, $5,917. She had not planned for that number. It came as a complete shock in April. Now here is what the strategy looks like. Before claiming Social Security, ideally in the years between retirement and age 70, the window is open to do Roth conversions. You take money from your traditional IRA, pay the tax on it now at today's rates, and move it into a Roth IRA. The Roth grows tax-free. Withdrawals in retirement are tax-free. And critically, Roth withdrawals do not count in the combined income formula. A 63-year-old retired engineer in Denver did 3 years of strategic Roth conversions before claiming Social Security at 68. He converted $45,000 per year, staying just below the 22% bracket ceiling each time. His total tax paid during conversion? $22,600 over 3 years. His combined income after claiming Social Security? $31,400. Below the $34,000 threshold, 0% of his Social Security taxed. Same savings, completely different outcome. The difference in federal tax over 20 years of retirement? $71,000. Most people hear, pay taxes now on a Roth conversion, and stop reading. They think, why would I pay tax today that I could pay later? Here is what they are missing. Later, you have required minimum distributions, forcing money out of your traditional account whether you need it or not. Later, you have Social Security income already in the calculation. Later, tax brackets and retirement tax rules may change again. And once Social Security, RMDs, pensions, and investment income are all hitting your return at the same time, you may have far less control over your taxable income. The cleanest window to convert is usually before RMDs begin and before Social Security starts adding to your combined income. That window does not disappear completely after you claim, but it can become smaller, more expensive, and harder to manage. That brings me to account number 2, and this is the one most people, including many financial advisors, overlook completely. Stay with me here because this next section changes the calculation for anyone who has a brokerage account, a savings account, or a bond portfolio sitting outside of their retirement accounts. Here is the fact that sounds wrong but is completely true. Even tax-exempt municipal bond interest, the kind that is not taxed at the federal level, still counts in the IRS combined income formula for Social Security taxation. Read that again. Income that is federally tax-exempt still triggers Social Security taxation. This is written directly into IRS Publication 915, line 1B of the Social Security Benefits Worksheet. A 70-year-old retired accountant from Milwaukee, someone who spent 35 years understanding taxes, had $200,000 in municipal bonds specifically because he believed the interest was tax-free. It was tax-free at the federal level. But that $7,200 per year in municipal bond interest went directly into his combined income calculation. It pushed him $7,200 further past the threshold. It caused an additional $6,120 of his Social Security to become taxable income. Additional federal tax cost, $1,346 per year, every year. $1,346 over 20 years. That is $26,920 on money he specifically structured to be tax-advantaged. The system does not warn you about this. There is no asterisk on the municipal bond brochure that says, "This income still affects your Social Security taxation." Nobody told him. Now here is what the brokerage account issue looks like in real numbers. A 68-year-old couple in Scottsdale, Arizona, has a joint brokerage account with $350,000. The account generates $14,000 per year in dividends and capital gains, which they reinvest and do not spend. That $14,000 still counts as income on their tax return. It goes into their AGI. It goes into their combined income. It pushes 85% of both their Social Security benefits into taxable income. They are paying an additional $4,100 per year in federal tax on income they never even deposited into their bank account. That is $341 per month leaving their financial picture for dividends they reinvested. Over 20 years, $82,000 for money that never passed through their hands. The strategy before claiming Social Security is to audit what your taxable accounts are generating and restructure where necessary. Move dividend-heavy funds to growth-oriented funds with lower annual distributions. Consider tax-managed index funds. Consider whether assets would be better repositioned inside a Roth or a health savings account. None of this requires selling everything. It requires a deliberate review before the Social Security claim date, not after. Now I need to show you account number 1, because this is the account most people do not think of as an account at all. And yet for certain retirees, it is the single largest driver of unintended Social Security taxation. And if you have this account and you've already claimed, I'm going to tell you something important on the other side of this that you're going to want to hear. Every dollar of pension income, every dollar of rental income, every dollar from part-time consulting, every dollar of annuity income, all of it lands in adjusted gross income. All of it feeds the combined income formula. All of it drives up the percentage of your Social Security that is taxable. A 69-year-old retired firefighter from Chicago receives a pension of $38,000 per year. He also receives Social Security of $24,000 per year. His combined income, $12,000, which is half of his Social Security, plus $38,000 pension, plus $1,800 savings interest, total $51,800. Well above the $44,000 married filing jointly threshold. 85% of his $24,000 Social Security, $20,400, taxable. Federal tax on Social Security alone, $4,488 per year. He cannot undo the pension. He cannot unclaim Social Security. But here is what he can do. And this is what separates retirees who manage this well from those who do not. He can direct every dollar of discretionary spending in retirement toward tax-free sources first. Roth IRA withdrawals, health savings account distributions for qualified medical expenses, life insurance policy loans if applicable. He can reduce his taxable income by maximizing deductions, including the additional standard deduction for people over 65, which in 2026 is generally $2,050 for single filers and $1,650 per qualifying spouse for married couples filing jointly. And from 2025 through 2028, some taxpayers age 65 and older may also qualify for an additional $6,000 senior deduction per eligible person, subject to income limits. He can make qualified charitable distributions from his IRA up to $111,000 per person in 2026, which can satisfy RMD requirements without the distribution touching his AGI. He cannot undo the past, but he can manage the gap going forward. Here is the cruel irony that the system has never explained to anyone. The people most affected by the 85% taxation rule are not wealthy retirees. Wealthy retirees have accountants, trusts, and structures to manage this. The people most affected are middle-income retirees who did everything right. They saved consistently. They took Social Security at a reasonable age. They have a modest pension. They have a brokerage account with dividends. Every one of those responsible decisions compounds the taxation problem. The tax code punishes responsible savers for being responsible savers. And the thresholds that create this punishment, $34,000 and $44,000, have not moved since 1993. If those thresholds had simply kept pace with inflation, they would be approximately $70,000 and $91,000 today. At $70,000 and $91,000, the vast majority of middle-income retirees would pay zero tax on their Social Security benefits. But those federal Social Security taxation thresholds have not been indexed for inflation. Unless the law changes, more retirees can keep getting pulled into the tax calculation over time. That is not something you did wrong. That is the system working exactly as it was designed, just not for you. I need to show you what the too late scenario looks like, because it is real, and it happens every single day. A 72-year-old retired school principal in Atlanta claimed Social Security at 66. She had $620,000 in a traditional IRA. She never did Roth conversions because nobody suggested it. Her required minimum distributions began at age 73. Her first RMD? $23,600. Added to her Social Security, her pension, and her savings interest, her combined income hit $67,400. 85% of her Social Security taxable. Federal tax bill? $9,200. She called a CPA in January of that year. He told her the window for pre-claim Roth conversions had closed in 2018. If we had done this 6 years ago, he told her, we could have reduced this by $60,000 over your retirement. Now we manage around it. That is a hard sentence to hear at 72. You are not there yet. If you are between 55 and 69 and you have not claimed Social Security, the window is open. If you are between 59.5 and 70, you can begin Roth conversions right now. No penalty. Full access to your traditional IRA or 401k. The strategy is available to you today. The window does not stay open forever. It can narrow when you begin taking Social Security and your combined income is already past the thresholds. It narrows again when you reach RMD age and required minimum distributions force income into your return regardless of strategy. And because tax laws can change over time, the earlier you map this out, the more control you may have. If you are in the window, today is the right time to map this out. And here is something that most people in your position do not know yet. Some states do not tax Social Security at all, regardless of what the federal government does. States like Florida, Texas, Nevada, and Tennessee have zero state income tax. States like Illinois, Mississippi, and Pennsylvania exempt Social Security from state taxation, even if the federal government taxes it. A couple retiring in Minnesota versus a couple retiring in Florida with identical income can see a state-level difference of $3,100 per year on Social Security taxation alone. Over 20 years, $62,000. Same federal check, different state. $62,000 difference. Location is a tax strategy, and it is one nobody sits you down and explains. Before I give you the action checklist, I want to address one more thing. Because some of you watching this are past the claiming date. You already claimed. You have RMDs coming. You feel like this conversation does not apply to you. It does. The Roth conversion window is still open if you are under 73 and have not yet started RMDs. Even if you have claimed Social Security, partial conversions can reduce the long-term RMD pressure. The qualified charitable distribution strategy is available starting at age 70 and a half. In 2026, you can redirect up to $111,000 per person from your IRA directly to charity. It can satisfy your RMD, it does not touch your AGI, and it does not enter the combined income formula. The Senior Standard Deduction Bonus is available to you right now. You do not need to itemize to claim it, and if your income is high enough, above $109,000 for a single filer, or $218,000 for a married couple filing jointly in 2026, you may be in IRMA territory, which adds Medicare Part B and Part D surcharges on top of the Social Security taxation. That is a separate video, but it connects to everything we discussed today. The point is, wherever you are in this process, there are moves available to you. The system counts on you not knowing them. Today, you do. Here are your next steps. Every single one of these can be completed in under 30 minutes. Step 1. Pull your most recent tax return, Form 1040. Go to line 6B. That is the taxable Social Security amount the IRS recorded. If it is above zero, you are already inside the trap. If it is not there yet, you have time. Step 2. Download IRS Publication 915 from irs.gov. Go to the Social Security Benefits Worksheet on pages 16 and 17. Run your own numbers. This takes 20 minutes, and it will show you exactly where your combined income lands. Step 3. Log in to ssa.gov and check your projected benefit at different claiming ages, 62, 67, and 70. The difference between claiming at 62 versus 70 can be $800 to $1,200 per month. That gap also changes your combined income calculation and your tax exposure. Step 4. List every account that generates taxable income: traditional IRA, 401k, brokerage account, pension, rental income, savings interest. Write down the annual amount next to each one. That list is your combined income map. Step 5. If you are between 59.5 and 73, contact a fee-only fiduciary CPA or tax-focused retirement planner and specifically ask them to run a Roth conversion analysis for the next 3 to 5 years. Ask them to show you the break-even point, the Medicare impact, and the 20-year after-tax outcome. Step 6. Check your state's treatment of Social Security income. Go to your state's Department of Revenue website. Search Social Security Income Tax Exemption. This takes 5 minutes and could be worth tens of thousands of dollars if relocation is ever on the table. If this video saved you money today, or showed you a number you did not know existed, hit the like button. It takes 1 second. And it puts this information in front of retirees who need these numbers and have never seen them explained this way. Drop a comment below with the account number that surprised you most. Account 1, 2, or 3. 2 seconds. I read every single one, and your comment helps me understand what to cover in depth next week. If you want to go deeper on the IRMA Medicare surcharge trap and how it connects to everything we covered today, that video is right here. Watch it next. This is Jonathan Mercer with Tax-Free Retirement. I will see you in the next one.